Hey, how you doing? This is Peter here at the McKernan Group. Want to talk to you. So one big thing, big conversation I know a lot of people have been talking about, I've had videos on it about the feds and also inflation. So they were talking, at least the feds were talking about it being transitory, where what that means is, you know, it comes in, then it goes away within a short period of time, 3 to 6 months. Well, that's not the case. It's going to be here for a lot longer. I think a lot of people saw that, especially with a lot of the money that's, you know, been infused into the marketplace and the United States, and then across the, you know, globally. So with, you know, the feds, and ultimately what they had a meeting last Tuesday. They had a conversation where what do they do ultimately? You know, this is more general of having inflation. The challenge, you know, that they see is they typically raise interest rates if they have inflation. So and the inflation typically is about 2.5%. So that's, you know, just normal standard inflation. Well, we're at 7% now, and that was just, you know, that just came out this last week. The feds had a meeting, and this is, you know, mid-January, so they basically said, well, how do we combat that? Well, we combat it by increasing interest rates, which aren't home interest rates. They're interest rates, and then they affect, you know, the interest rates to buy a home. So this is one thing that's, you know, particularly interesting, especially when you're going to go buy a house. And then also any type of real estate professionals want to know this, and the general population, because it can slow things down. And that's how they really combat the inflation. So inflation is ultimately, you know, increasing in product supply and everything else. Well, they're going to increase the interest rate to combat that inflation to go to like 3.5 to 3.75% to really help out. So it kind of slows some things down, because there's a lot of stuff that's going on in the economy that they need to taper off and slow down a little bit. And they're going to use those tools. And they said initially last year in 2021 that they were going to only raise it twice. Now they're talking about 4 times this year. And they were talking about, you know, mid 3s to maybe high 3s this year. Sounds like, you know, they're going to ultimately get to that number. They may get to it quicker, just depending on what they see and is going to fit the United States economy, and then ultimately, you know, the global economy. But because usually what we do here in the United States affects the global economy. But they're going to increase interest rates. So that's one thing that I see is not going to deter buyers, but it's going to give the market a little bit of a breath comparatively to what we've seen in the last 18 months of appreciation skyrocketing. I think it's not going to affect the market where we're going to go down, or we're going to go, you know, where we're in a plateau. It's still going to go up, but it's going to give people more choices. So one thing to really look out for is, for one, make sure that you're always, you know, checking the interest rate, make it with your loan professional, and make sure that that loan professional is on the ball with giving you updates for as you're looking for what the interest rates are, because that can change. I don't think when you go from, you know, 3.25 to 3.5, you know, maybe it changes $100, $150. I don't think that's going to affect someone's, you know, bottom dollar for what they're going to be able to afford. However, it's just something nice to know and have that tool in your, you know, tool chest. I mean, granted, back when inflation, you know, was super high in the 70s, we were at 12%, 16% interest rates. So, and people were still buying properties then. So 3.5, 3.75, that's still very, very low comparatively to that. And you know, obviously prices are higher versus when they were then, but the purchasing power of people, just because incomes have gone up too, are a lot higher than they were back then as well. So those things kind of combat it. So I would watch that, be in tune with the market, be in tune with your lender, and then also be in tune with the interest rates and what they're going to do. So thanks for watching. If you guys have questions, leave them below.